Welcome to the daily update, where I'll go over the action in the market from Monday, October 2nd, and then we'll see how things look for Tuesday, October 3rd. We were unchanged. We were up just fractionally in Monday's session, although that goes in the books as an up day, but really nothing was decided overall. We're still negative in the short term, and we're dealing with an oversold condition, a little bit oversold in the intermediate term, where we continue to be negative. In the long term, we're still hanging in there for right now, but the market is really having a difficult time being convicted of going either up or down from here. We're at support, so we could go up. We also are negative technically, so we could go down, and everybody seems to have an opinion, but we just follow what the charts are telling us and then act accordingly. Let's go back and talk about what happened. Right at the open, we had a flat open. Now, there was a continuing resolution that was passed over the weekend to avoid the government shutdown, but really nothing was decided. They did keep out more funding for Ukraine, but there might be some kind of a special deal going on that's separate from that. But all they've done is just delayed it 45 days, which will mean we're coming up to Thanksgiving, another holiday. They're hoping people will be distracted by that and not really paying attention to what they're doing so they can play more of their political games. Well, we were quite positive with the futures when they opened on Sunday. Now, that's either afternoon if you're on the West Coast, that's evening if you're more on the East Coast. We were up anywhere from 0.5% to 0.75% at one point. But then as Europe opened and as things started to move throughout the night, we saw the futures drifting lower. And by the time we hit the open, we were pretty much unchanged. So prices had a flat open. We drifted lower. We went down to that 42.75 area, which for some reason seems to be kind of important. And then we rose from there. We hit resistance at the daily pivot at 42.99. We ticked a little bit more than that up to 4,300, and that's now providing overhead resistance. As the day went on, we fell below the unchanged level, so that didn't provide support. We went all the way down to S1 at 42.64. Then we bounced from S1. That failed, but then we bounced again after coming back down to S1, and prices were able to climb back just about to the unchanged level. And then by the time we closed, we were just a tick or so positive. We were up 0.01% on above average volume, so that is picking up. And the technicals in the short term were still more negative, but oversold. Intermediate term, negative, kind of oversold. Long term, we're still positive. It's about inflation, interest rates, growth concerns. What's the Fed going to say? And then what's the Fed actually going to do? Some comments. Interest rates continue to climb, and that's what started to put some real pressure on stocks. They're going to levels that haven't been seen in quite a while, and stock market participants aren't real happy about that. The mega caps did rebound late in the day. So growth had a fairly good day. There are some positive things that we can pick out that I'll go through in this video. Some other areas that maybe were looking positive, they're kind of starting to weaken just a little bit. But later in the day, we did see the mega caps really go up, and that really helped growth to outperform value, which was strong on a relative basis when you compare it to value. The micro caps are still back down below 100. That's nothing magical. It's a round number. I have a line drawn on the chart. When we're above that, we feel a little bit better. When we drop below that, it's a little bit more negative. Here's our short-term list, and it really hasn't changed all that much. We have our 20-period exponential moving average. These are all extreme negative, and you could count them as oversold. The Stochc RSI, the Williams percent R, the CCI 20, the stochastics, the standard deviations chart. We have one new addition to our intermediate term oversold or extreme negative reading, the 50-period exponential moving average. The new one is the S&P 500 McClellan oscillator. It's now dropped down. The PMO studies, and then we're keeping an eye on the chicken money flow. We're seeing a little bit of an improvement there after getting kind of extreme, even though we don't use that like an oscillator. Could that be showing some signs of improvement? And then we have our current scenario that we've been dealing with for about a month now, that the economy is stronger than expected. And okay, so that means the Fed's going to have to keep rates higher for longer. Well, in addition to that, if we keep getting more strong economic reports, that might mean that they're going to go in and actually raise interest rates, and that's causing some concerns. We're keeping an eye on the Chinese economy since so many companies do business with China. And then oil going up is producing some inflationary concerns as well. The scenario that I came up with about a week ago, I thought would take a couple days to play out, and then that scenario would work itself out and it would be done and gone, and we would go on to the next thing. Yeah, we're just kind of still playing through this scenario where we're coming down to that long-term trend line. At the same time, we're oversold. That's still continuing. And we're coming out of the weak seasonality, the latter part of September. It doesn't mean that October is all that much better, but it tends to be better than September. But we're not seeing any real resolution to this scenario, so I'm keeping it on here for now. The dollar was up and interest rates were up, and both of these together are pressuring stocks. We still have the 30 to the 5-year that's gone back to being normal. I'm keeping that in blue because we've seen this before, only to have it go back to being inverted again. The other yield curves that we follow still remain inverted. We didn't change on a sentiment basis. We're still negative at 28, and our trend is still negative. The ADX is above its moving average, so that means it's getting stronger. And we're above 20, both with the short term and intermediate term. For right now, I'm keeping our bias and momentum at mixed because the market is just really lacking any conviction. The economic reports that came out, we had the September ISM manufacturing PMI that came in at 49, more than the 47.8 that they had expected. That's the stronger than expected part. And it was up from 47.6 last time. So this produced some concerns. On the other hand, you can see this is negative because it's below 50. That shows contraction. Total construction spending was up 0.5% month over month, as expected. Last time it was up 0.9%. Total private construction was up 0.5% month over month. Public construction up 0.6% month over month. When you calculate that out to a year over year basis, we're up 7.4%. Here's a chart showing the manufacturing PMI, where we did go up from the previous reading, but we're still below 50. Then looking at the ISM index, first we look at the total, which is the blue line, where it's declining and below 50. And then the orders are, they had been ticking back up, we did see some weakness in this latest reading. The ISM prices and deliveries, the prices are the blue line, where they're pretty much flat right now, and deliveries are starting to see a bit of an improvement. So that could mean some economic strength there. The ISM trade, looking at exports, that's the blue line, where they ticked up slightly, where the imports have declined. Then the ISM index, looking at a month-over-month basis, it did show a bit of a decline from last time, but it still was stronger than what the market was expecting. We're also keeping an eye on the 10-year Treasury yield. We settled after Monday at 4.68%. That's above the 4.02% that this research suggests is going to have a negative impact on stock earnings. Here's the intraday chart where we were pretty much flat right at the open and didn't show a lot of conviction one way or the other. We started to drop a little bit lower. We tried to go back up here to the 4,300 level. This daily pivot was acting as resistance. We fell down below the unchanged level. We came down to S1, tried to bounce off of that, came down to it again, and then saw some strength later in the day. And that can be taken as positive. Then looking at growth versus value, where growth was up on the day, that's the blue line. Value saw some strength near the end of the day, but it ended up being down. This is the chart that's looking more positive. When we're looking at S&P growth versus value, we've been seeing since about the 21st or 22nd of September, we've been seeing a gradual upward movement with growth. And that's the buy low, sell high that really helps the market to go higher. Well, this really spiked up in Monday's session. So that is quite positive. When we look at it on an end of day basis, we're not seeing anything all that great. That's why we also like to look at this on an intraday basis, where it's still going sideways and it's still in a longer term uptrend, but we didn't see the move up like we saw intraday. Looking at our trend, where we are above the moving average in the intermediate term, so that suggests the trend is getting stronger. We're also above 20. The red line is on top, so we default to positive. We're seeing pretty much that same thing in the short term, above the moving average, red line on top, above 20. Then looking at the VIX, and I feel like a broken record here, but we're in that period now where this blue line goes higher and higher, which that means if this is going up and if we stick with what the average has been, that could be negative for stocks. Then looking at the VIX on a daily chart where we ticked up just slightly with the line chart as well as the bar chart, and we're above the moving average based on both. And so that's just suggesting that volatility is picking up. We look at the VIX of the VIX where it did tick up a little bit with the line chart as well as the bar chart. And this fear gauge is still really starting to climb, showing that fear is increasing. We look at the VIX to VVIX ratio. This is negative since we've turned and started to go back up. Then looking at the 5-period simple moving average, this had been a positive sign after Friday's session. Well, now we're starting to tick back up again. And so that is turning things back from being positive over to negative currently. And our longer term equity put call ratio is also continuing to go up, and that is negative for the market. The Ulcer Index continues to climb, showing fear is increasing. Our advanced decline line, we're dropping below the moving average based on price. We've already been below the moving average based on volume, and that showed some weakness. This is where we saw some more internal weakness in the S&P. The new lows just blew out in Monday's session. We're really declining with our 5-period and 10-period moving average. The advanced decline ratio still below 0 and declining. That is negative. Accumulation distribution. This is potentially a little bit positive. We actually ticked up slightly, even though we're below a declining moving average. So when we look at the Chaikin money flow, after getting this extreme reading here, which again, we don't use this like an oscillator, but we can kind of lean that way based on what we're seeing here. We're seeing this improve. Now it's still negative, but it's starting to go back up, and that could be positive. The ratio between risk on and risk off is continuing to show some improvement. We've seen that 2 days in a row now, where longer term, this is declining. And then looking at the cumulative advanced decline line for the NYSE, we just dropped off a cliff. We just set a new low for this particular chart. And we're also declining with our regular advanced decline line for the NYSE. We're dropping well below the moving average here with our other measure of the NYSE, and we're below this upward sloping trend line. Haven't looked at this in a while. The common stock for the NYSE based on price is starting to show some weakness, but not really breaking down the way we're seeing it in other charts. And we're pretty much matching that when we look at the AD volume. Here's our daily chart where now we're just about on this trend line now. Instead of coming down here, hitting it and bouncing in the other direction, which could have easily happened, we're just kind of camping out along this trend line currently. On the bottom, we have volume as back to being above average. And I'm showing a little pickup in volume here. This is our volume studies chart. We were so below average, I just wasn't including this chart for a while, but it's starting to pick back up. The Stochc RSI is still extreme negative. The Williams percent R is extreme negative. The CCI 20. The 14 is not on this list, but our stochastics were still extreme negative in the short term, showing some improvement, but still extreme in the intermediate short term, turning up, but still extreme negative in the long short term. The force index didn't really change all that much. It's continuing to be negative. It's worked off being extreme negative and back up closer to the midpoint. And here's our short-term rainbow where we continue to be underneath the rainbow. The longer we stay below this, the more these lines are going to roll over. Here's an intermediate term rainbow. We're below all of the moving averages in this rainbow. And again, the longer we stay below this, the top lines are already starting to roll over, but there's not an awful lot of damage that's been done, at least yet. Then looking at the Swenlin trading oscillator, this was supposedly positive for Friday's session. After Friday's session, but we're turning back down now based on price and volume, and we're below 0. The go, no-go system is changed to a more lighter shade of purple. Isn't that a song? No, I guess it's lighter shade of pale. But we had been deep purple. Now we're more light purple. The TTM squeeze, also keeping an eye on this. I have a black line down here, which sometimes marks an extreme negative reading. But we're matching up where we hit the low back in August, and we're getting close to the level where we set more of a genuine low back in March. So we're keeping an eye on this to see if maybe we're getting a little extreme. The balance of power still below the dashed line, that's negative. The 20-period exponential moving average, extreme negative, as is the 50, and we continue to decline with the 200. Now, this was kind of a surprise to look at the bullish percent index, and we were pretty much unchanged on the day, but the downward movement that we saw kicked in a whole lot of new bullish percent index sell signals. Now, what this chart measures are the point and figure buy or sell signals of all the stocks in the S&P 500. And when we see this going down, that means that there's a lot more sell signals being generated. Could we get down to an extreme negative reading, which often gives some support to the market? We're not there yet, though. So for right now, this is quite negative. The S&P 500 McClellan oscillator is now going extreme negative again and still could go further. The summation index based on price and volume continue to decline. Also, the NYSE summation index based on price and volume is also declining. We have remained at neutral for the Elder Impulse system for the S&P, and we're not really seeing more damage here with the 200-day simple moving average of the S&P 500, but we're starting to break down below these previous lows when we look at the 50-period moving average study. The PMO showing that on a momentum basis we are negative. We're also declining based on price and volume. In our PMO studies, we're not quite extreme yet, but turning down with the PMOs that are rising. We're still extreme negative with the buy signals, and we're declining to trying to flatten out here with the PMOs that are above zero. The NYSE bullish percent index is still below 50 and declining. That is negative. After seeing some hope after Friday's session, the NASDAQ 100 bullish percent index, it was ticking up. Well, in Monday's session, it's ticking back down. So that's turning more negative. The slope oscillator also continues to be negative, but we're getting down here to kind of an extreme negative reading. And we're kind of seeing that same thing with the MACD. It continues to decline. So it's negative, but other times when we got down to this level or even a little bit below it, sometimes that can mark a bottom. So when we look at all of our oscillators, we're still declining in the short, intermediate, and long term. All momentum is going down. Here's our moving average tree where we're still dealing with this 200-day exponential moving average, which is strange. The market doesn't really pay attention to that. Well, for right now, it's kind of a big deal. We're wondering, are we going to drop down to the 200-day simple moving average, or are we going to build a base of support and then go up? Now, what I was pointing out after Friday's session is it looked like this could be showing some healthy movement where we were seeing higher highs and higher lows. Well, we kind of broke that pattern in Monday's session, but we're still above the 200-day exponential moving average. So that is holding. We're right in the border between the -2 and -3 standard deviation. And we're still negative with the parabolic SAR. We're still below this 100% retracement level with our fib study. We're also below the 61.8% retracement level on this chart. So we're still having support that we broke. And now if we come back to it, it could be providing overhead resistance. But this still could provide some support if we continue to fall with this longer term fib chart. We're slightly below 100 now with the micro caps. And we're just a little bit underneath the upward sloping trend line. This is the long-term trend that I've been talking about. And the scenario that I thought would play out quickly, well, we're just taking our own sweet time with this. And then this was pointed out by David Keller, suggesting that maybe the S&P has formed a head and shoulders top. Since we dropped down below these 2 points here, that means that it's confirmed. This chart hasn't updated in a few days, but if you really heed these kinds of chart formations, then you're probably more negative right now. The Heiken Ashi has a dark candle that's negative, where the Kegi is now pointing back down. That is negative. The Renko is negative, and the 3-line break is also negative. The equal weight index is continuing to underperform the S&P 500 weighted index. And we're seeing a bit of a spike up here. This is when the mega caps did better than the rest of the market. We saw this ratio really go up, which that's where we've been getting a lot of strength from in 2023. So maybe this going up could be positive. We're still below the 200-day moving average with the Dow. and we have switched from being negative to neutral. And that's strange. This is a proprietary system here where we actually were down with the bar, but we went from being negative to actually going to neutral. Kind of strange how that works. When we look at the NASDAQ 100, this is still looking okay, where we might have dipped lower and showing some improvement with the chart movements anyway. But the NASDAQ 100 has a lot of overhead resistance it needs to break through. And the Elder Impulse system for the Qs still remains neutral. We're still above the 61.8% retracement level for the NASDAQ 100. And this is also looking a bit better for the NASDAQ, a little bit more healthy chart formation that we're seeing. And we're dancing above and below the 50% retracement level for the NASDAQ when we look at our fib levels. And we're still watching this with the FANG index. We came down and basically tested this previous low, and it's starting to show some improvement as far as the chart is concerned. The small caps, though, they're just getting taken out and shot. They're dropping below the pivot right now and looking more negative. Also wondering if we're creating a head and shoulders top with the Russell 2000 small cap index. We're going down with the RSI. We dropped down below these previous lows that may have been building a base, and we're continuing to decline with the MACD. Then when we look at the Elder Impulse system for the small caps, we went from neutral to negative. The mid caps also coming right back down to this pivot point. So for right now, on a closing basis, this support level is holding. And the mid caps have switched from being neutral to negative. Now that makes sense, but to go from negative to neutral on a down day, that's strange. Looking at traditional Dow theory, we are declining with the Dow, we're declining with the transports. The utilities are just getting hammered because the rise in interest rates puts a lot of pressure on these companies. And we saw a real spike up in the 10-year yield where we climbed above anywhere we were last week. So when we go up with the yield, we're going down with price, and we're in a solid downtrend. We are starting to get extreme negative with the RSI, but the MACD is still comfortably negative. And this is going back to being a little bit more normal. I was watching this because of the whole government shutdown threat, and we were getting a zero result. Well, now when you take the 1 month and subtract the 3 month, we're getting a negative answer. And the 30 to the 5 years still above the zero line, so it's gone back to no longer being inverted. We're still just about at the midpoint of this longer term trend channel, so that's somewhat positive. And we're coming right down to this longer term trend line when we look at the arithmetic scale. And so this support continues to hold. We're also keeping an eye on the 10-year yield, and we're subtracting the German 10-year yield. And the correlation between the upper line and the middle area, which is the US dollar index, is continuing to show some improvement as interest rates are going up, and the dollar has also been going up. And I wanted to bring this up because we're seeing a bit of improvement between growth and value. So when you look at the Qs to the S&P, they ticked up in Monday's session, showing some improvement with discretionary to the S&P, and turned up when we go from large cap growth to large cap value. With the large caps, we're seeing some improvement, the mid caps and the small caps. So this could be some under the surface improving that's starting to build. We just haven't seen it confirmed yet based on price. Now, this has been more longer term positive, and we're starting to turn negative. We're dropping below the zero line here with this red line. When we look at our 50-period exponential moving average of the new highs minus the new lows, we look at the indicator, and it's been spending a number of days, that's the black area, below the zero line, which is dragging the red line down the moving average, and that's why we're turning more negative. So this could be intermediate to long-term negative if this continues to build in a negative direction. The S&P to utilities ratio really spiked up. It's not because the S&P was up, it's because the utilities are going down, and this can often give support to the S&P. We just need to see some follow through based on price. So that's another positive area. We're seeing growth, we're seeing utilities underperforming, but another area that's pushing against stocks right now is the advance of the dollar. We're up into the 107 range. Then we look on a momentum basis for the NASDAQ 100. We are turning up. We could be bottoming out here, but we haven't crossed over positive, and both of these lines are still below zero. And I haven't received the latest bit of research from Tom Bowley for October. I'm just keeping this here so that I don't forget to include that when I do finally get that information. So what's our outlook for Tuesday? We're dealing with earnings as they're coming out, and now we're starting to head into the next earnings season. So that could be pretty influential for stock prices. The UAW strike is still continuing, but the government shutdown, at least for right now, has been averted until Thanksgiving. Student loan repayments are going to be restarting, and that could drain the economy quite a bit. Our technicals are still negative. I really haven't changed anything here. In the short and intermediate term, we have a downtrend that is now confirmed, but there are some signs that we're seeing of an improving picture, but we're just not seeing a follow through with that based on price. We will get the JOLTS job openings in Tuesday's session, and then we're keeping an eye on all of the different geopolitical events. Here's the updated calendar. We're going to get ADP on Wednesday. That's another employment report. We'll get weekly jobless claims on Thursday, and then we'll have the big employment report coming out on Friday. Here's the Stock Traders Almanac statistics for October 3rd, where we are negative with the Dow being up only 38.1% of the time. We're neutral to negative with the S&P and NASDAQ, so it's not an overall positive day. Here is the month of October. We're following the green line because that's where we have a sitting president who is running for re-election, where sometimes we see a bit of a bounce here, but later in the month, be warned, historically, we have seen some weakness. We're also in this yellow area right here in October, where sometimes we see a bit of a bounce, but after that, we might see some weakness, at least on a historical basis. And then looking at the NASDAQ, we're a bit of a bounce and then some weakness going forward. And with the S&P, a bit of a bounce and then some weakness. So we never will necessarily play out exactly the same way, but on a shorter term basis, if we start to see some follow through based on price, we might get a little bit of a bounce. But then we might also see some more weakness as we get later on in the month of October. And then we're up 10% or 10 of the 18 times going back to 1950, where we're down 8 out of the 18 times. So it's a slight lean in the positive direction. And then I've been including this just because Jeffrey, what's his name, from Stock Traders Almanac, Hirsch, he's coming out with a seasonal chart of Bitcoin, where if you follow the green line, that's from 2018 to 2022, which is more current. We tend to see some positive seasonality for the Bitcoin index, where we're pretty much sideways when you look from 2011 to 2017, and nothing all that special necessarily if you take all the years together. Our scenarios for Tuesday, we're still leaning towards the down scenario. Our charts are suggesting that, but on a short and intermediate term basis, we are still showing some oversold conditions, and we're also seeing some signs of improvement, but we can't justify going long, at least at this time. We don't have any confirmation of that from our charts, and we're not going sideways now because our ADX, both the short and intermediate term, continue to be above 20. So our warning signs, the trend signals, and I went over this in the weekly video, we're still below those longer term trend lines. We're in a better month now that we're in October, but it's not necessarily all that great. The equity put call ratio is now going back down. This went from the positive list back over to the negative list. And our longer term equity put call ratio is also going up. I think I should have put the equity put call ratios going up. That's a typo right there. The risk on posture, it's been weaker longer term, but it has spent the last couple of days going back up. The S&P oscillators and the NASDAQ oscillator that we follow, those are all negative. The cumulative new highs, new lows for the NASDAQ, and this has gone on for a few years now, they continue to show weakness. The 3-month yield, we're still above where we were back in 2007. The S&P is underperforming utilities. Well, maybe not now. The S&P is starting to break out a little bit. So if we see a little bit more follow through with this, this will get switched over to the positive side. And Staples S&P 500 didn't see a real big change there in this ratio. So I'm waiting to see if we see a little more follow through there as well. The Russell is still below its 200-day moving average and wondering if we hit a head and shoulders top. The parabolic SAR is negative, and the vortex is negative. And then we're coming to the end of one earnings season, and we're going to be heading into another one here pretty soon. The positive sides, we still have seasonality and setups that are in the background. And again, I went through those charts in the weekly video. The daily special K chart is still positive. The S&P is still above the downtrend channel upper line. The Russell, the small caps, and the mid caps, believe it or not, even though we're seeing a lot of shorter term weakness, they're still working off of recent golden crosses. Small and mid cap growth is still hanging in there for right now. The financial sector, even though it's been getting hammered, it's still generated a recent golden cross. So our conclusion, we're negative in the short and intermediate term. We're in a downtrend that is confirmed. You could make a case that it's somewhat oversold in the short term, but there are some little signs of improvement here. We just now need to see confirmation based on price. We're also negative in the intermediate term and slightly oversold, but could be showing some improvement, or we're still positive in the longer term. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.